All right, I got 1:30. Let's get things started. Hello, everyone. My name is Paul Santomauro with FRANdata, and today is a continuation of a series of webinars that we've been having on the SBA franchise lending world. And we've been talking over these last couple of weeks and months about two main issues that lenders are facing: eligibility and performance. So, can we make these loans? Are they eligible for SBA? And then how are these units actually performing? And that's both on the franchise level, so the franchisor, and on the unit level, how they're performing on the ground. This has really driven a lot of the conversation and questions and things that we've seen, for the better part of this year and stretching back into last year. For folks on the call who maybe are here for the first time, we don't know who we are. FRANdata is the leading research and intelligence information company that covers the franchise industry. And we have three main client groups. One main group are lenders. So many of the folks on the call today, the folks that are making the loans, so those hardworking franchisees out there in the world today. Franchisors, the brands themselves. So the actual franchisors who are selling the units and collecting the royalties. And then we have a third group that we call suppliers. So anyone who might be selling into those two groups. We're the research arm of the International Franchise Association as well. So we get a ton of information flow, both from banks and from lenders. And it's this unique position with both groups that enables us to have the impact that we have, both on the eligibility side and on performance, which we're going to talk about today. On the agenda for today, I'm really excited. I spent last week with many of you folks out there in the SBA lending group and world at the America East Lender Conference in New York City. So I wanted to start with some hot topics and questions and sort of chatter around that conference. What were lenders asking us? What were we talking about? We did a breakout session during that conference, and we had some great guests on the panel. We had an attorney, we had a representative of 504, and we had an SBA lender as well on. So there's a lot of back and forth and great things that were shared. So I want to sort of translate some of that as best I can to you guys today. Then I want to go in and look at some of the nitty gritty, and we're going to focus the first half of the presentation again on eligibility, and something that we talked about both in the conference and in between sessions and in the breakout sessions. Or, what does the SBA SOP say about franchise eligibility? And in terms of what lenders are doing today, what is FRANdata doing alongside that to assist with SBA franchise eligibility? And we're going to look at a document called an eligibility certification, which we've had many franchisors sign, and we're providing on Franchise Registry as another way to solve for this issue. With that, we're going to take a live look at the Franchise Registry website, and then we're going to pivot over to underwriting and evaluating franchise performance. We'll give a little bit of an update on what we're seeing in the franchise lending market with some more input from America East. And then we're going to dive into this idea of prudent lending and franchise loans. We're going to look at the SOP, and we're going to see what the SOP says about looking at franchise performance. And then we're going to go in and see how FRANdata actually helps lenders fulfill that requirement with our underwriting report that we call Fund Report. So a lot packed in here. We'll have some time for questions at the end, but if you have some questions during the presentation, you can go ahead and send those in. Melinda's on the call with us. She's going to help me with the Q&A. So if I see something pop up in the QA box as we're going, I'll take a peek, but we'll have time to answer any questions when we get to the end of the presentation. So as I said, we want to talk about America East. We were in New York City last week, and the major topics around franchise lending from the participants in the conference and from the panel were really around eligibility and how different folks in the room were confirming their SBA franchise eligibility. And there was sort of a mix of responses. Some institutions were delegating this responsibility to someone internal that they felt had a lot of experience with franchise lending and had seen a lot of franchise agreements and had experience with eligibility over time. So one path was sort of an internal person that they felt comfortable, the institution felt comfortable reviewing the agreements. Another avenue for confirming eligibility we've seen has been contracting individual counsel, outside attorneys, to do that. And there are plenty of great providers out there that do that service. And some of the comments we've heard, from banks are that those services are available, but they tend to be a little bit more expensive and add additional cost and time to the deals that are typically passed on to borrowers. And then another group, of course, of lenders there are relying on FRANdata and our eligibility certification. We'll talk about that when we go in. So there's sort of a mix of approaches to the eligibility question. And a lot of what folks were sort of asking and confirming with others were, are you engaging with the franchisor? Where does the brand fit in this process? When do you engage them at all? When do you engage them? What are the kinds of questions that you're asking about their model and their operations? And pretty much the consensus around everyone was that there's a big role for the franchisor to play in the process. So it shouldn't just be with you and your borrower, and maybe they've handed you a franchise disclosure document. Of course, you're going to read that FDD and those disclosures, but engaging with the franchisor and reaching out to the brand has been a big piece of the solution for a lot of the folks that were in our sessions and were asking questions at the conference. We went over a couple of spot examples at the conference, and we had a wonderful panelist, Carolyn Calafiore from First Bank of the Lake, who gave some of her internal examples and challenges that she found with My Salon Suites and 7-Eleven. Both of those were ineligible deals that she had some examples to give. So those are ones that stood out. And there were two big burning questions that were addressed as well that I think I really wanted to relate to the folks on this webinar. The first was a question from the group that asked, can we rely on the SBA franchise directory? Now, everyone knows, or most of us should know, there was an SBA SOP change in 2023. We're actually going to take a look at that in a sec. And with this change, they removed that website, that SBA franchise directory, but they kept the website up. A lot of folks were using it as a reference point. And that was sort of baked into their process of, was something eligible, sort of check the SBA directory first. Well, Carolyn sort of gave us some examples of her policy and process at First Bank of the Lake, and really told us all in the group that we're too far away from that SBA directory for them to really rely on it at all. That Carolyn herself has seen so many changes in franchise agreements, even year over year, that where they may have felt comfortable maybe in Q3 or Q4, relying on that directory, she's just seen too much variance and change from the agreements that were previously approved to just rely on that solely. So that's been a big change that she's made, and that was one of the questions that we got from the group. And another question was, can lenders rely on submitting packages to GP, to the general processing, to satisfy the eligibility question? And this was one that sort of surprised some folks. And Carolyn had just been from a leadership meeting where she got the answer that you cannot rely on GP for determining SBA franchise eligibility. Basically told us a couple of stories where she'd submitted a package through to GP. They came back approving all aspects of the deal, but said specifically that they had not looked at franchise eligibility, that was the responsibility of the lender. So even sending this stuff into GP isn't going to solve the question of, is the brand eligible for SBA? So those were really, again, some of the hot topics that came up and some things that really stuck out to me that I thought I wanted to make sure to communicate to the folks that join our session. Now, we said we took a look at the SBA SOP, and what does it say about prudent lending to franchise borrowers? A little bit later, we're going to look at the language specifically and what it's now requiring. But depending upon the size of the deal and the loan program that it's in, if a loan involves a franchise, there's some specific underwriting of the franchisor that we're going to have to do in those situations. This is the SOP rule that brought us the current state of eligibility, and we just reviewed this during the breakout session. But this is again what I was referencing, the change that SBA made in 2023. They made two changes. They changed their review for affiliation, so their principle of control, affirmative or negative control, that establishes an affiliation between an entity. SBA said that franchise license or similar agreements no longer needed to be reviewed for these elements of control or elements of affiliation. And this is what the challenge is that they're saying, even though it no longer needs to be reviewed for control, it does need to be reviewed for other aspects of eligibility, sort of these non-affiliation issues. And when we look at our certification, we'll see what some of those issues are. But those are things like, non-disturbance in a torment language, discrimination, use of CBD, and that kind of thing. So this is the major issue that lenders are having. And this sort of pointed back to the original SOP of where this is coming from. Now, I mentioned that we at FRANdata are part of the solution as well, and I wanted to go over again for this group what we're doing to help lenders and franchisors with this specific issue of dealing with non-affiliation eligibility with SBA. We've created an eligibility certification document that's sort of a kitchen sink that covers all non-affiliation issues that were ever found by SBA through their eligibility reviews, what was on SBA directory, and our experience in dealing with both sides and the franchisor. It covers 26 of these issues that were commonly found. And again, we created them from all these past eligibility reviews. These are available to all SBA lenders. So anyone who's on the call that's an SBA lender, they're able to access this from our franchise registry website. Everyone on the call is able to get a login. I think we're going to go through that in a second. But the process for going through this, and we're going to show a couple of examples. is that the franchisor is signing an agreement that's attesting that their current year agreement, their current FDD, does not have any language or provisions in it that will make it ineligible for SBA. We are making this available for everyone on franchise registry, and this is a document that is updated on a yearly basis by franchisors as they issue their new franchise disclosure documents. So some of these brands got on this in the end of 2023. As their 2024 agreements come out, they have a 2024 certification that we list on the franchise registry. Now, I've got a sample here that I want to show everyone here so you can see an example of what we're putting in this document and what the language is around eligibility. So this is the document here. It's respective to the year of the agreement. We're on our 2024. And the franchisor fills out the top part, and there's some language in here that puts some teeth in this to what the franchisor is saying and attesting to in this document. The franchisor is certifying that all statements and information provided in the certification are true, that the franchisor understands and acknowledges that SBA and its participating lenders are going to rely on the certification, and franchisor acknowledges that submission of false information to the SBA or withholding material information can result in criminal prosecution. Then we have the body of the document, which is as I explained before. These are all of the non-affiliation provisions that may be present in a franchise agreement. So again, things like filing liens against real estate, non-disturbance in attornment language, business model eligibility. It's not a nonprofit. It's not a passive business. They're doing business in the United States. And we talked about passivity here. CBD products, is CBD a part of the product mix that they're selling to potential customers? And so this document lays out all those non-affiliation issues, and it's signed and attested by a representative of the franchisor. We're going to take a look at a document in a bit from a brand called Sport Clips. We're going to go online, pull from the franchise registry, and you'll see that it's signed and attested by a representative, in their case, the CFO, the Chief Financial Officer of Sport Clips. So that's the process for going through and getting certifications from a franchisor. Now, in terms of that process, come to franchise registry and check if there's a certification listed as early as possible as you can in the deal cycle. If you don't have a certification listed for that brand, reach out to us as soon as you can. We're going to reach out to the franchisor, and we're going to do our best to get that certification signed and posted on a franchise registry. There is no cost to this process. There is no cost to the lender to get a certification signed or to download one from franchise registry. Think of this as a community of interest. So when you get a certification for a deal, every other lender on the call and out there at SBA is going to be able to use it, and vice versa. Any certificates that have already been secured by the franchisor, you guys will have access to as soon as you log in. There is a cost to the brand to do this. Okay, so the franchise registry site that we're going to show you is a lender-facing site. So it's only for lenders. It's not for the general public. But the franchisor side of things is a service that we provide that allows them to submit their disclosure document and make it available to you. There's contact information for the brand that we're going to show you. We do their fund report, their credit score, and share it with them. We let them know where they're strong and where they're weak. And the certification agreement and process is part of that as well. It's a small fee. It's about $700 a year for a franchisor. It covers a lot. So, there's no cost to the bank, but there is a cost to the franchisor to do this. It's a small fee. So I just want to make that clear for the folks that are listening and maybe communicating with the franchisor or referring them to us. But again, no cost to the lender. If you run into this, just reach out to us and we'll initiate the process and kick it off with the franchisor. Where do we get the certification? This is, we're going to go into a screen share, but very quickly, you're going to log into franchise registry. We're going to search for the brand, and we're going to immediately go to the underwriting tab. Now, you'll see when we get in there, the underwriting tab has things like the franchise disclosure document. If your bank is an institutional subscriber to FRANdata, you're going to be able to download fund reports, request new ones, and whatnot from there. But for everyone that just logs in as a regular free tier access, you're going to get access to the franchise disclosure document and the eligibility certification. So we'll see that. And I mentioned before that anyone on the call here that's an SBA lender can get a free tier login to access franchise registry, search for brands, and do eligibility certifications. So if you don't have a password or login for the site, please reach out to us after the presentation, and we'll make sure that you guys get set up. And there's no limit to logins there. So if you maybe have a couple of folks that touch the franchise space, we can issue a login to all of them. And if they want to come on, and we can do a 15-minute call on our website and how we help folks, we can set that up individually with your institution. All right, so I promised a live look on franchise registry. I think we're going to do 2 live looks at franchise registry today, but I wanted to show you the workflow and the process and download live certification for a brand called Sport Clips, which most folks know. You come into franchise registry, you'll log in like I just did, and you're going to be deposited on the search page. And this is sort of a fuzzy match where I can search for sport clips, obviously, but I could just search for the word sport. Now, in franchising, there's a lot of brands that have the word sport somewhere in and around their institution. But we can see right here in the middle, we have sport clips. And when we find the brand that we're looking for, we are immediately deposited on the general tab. Now, I talked about contact information for the franchisors. That's made available to anyone, whether you're free tier or not. It's part of the service on the franchisor side. And they are making contact information available in 3 key roles within the brand. And those correspond to different roles within your lending institution. So the SBA contact, which is all the way on the right here, the SBA contact is a contact to reach out to for any process-related issues having to do with your deal. Typically, that manifests itself as needing a signed franchise agreement prior to first disbursement of funds, but there are other issues. There may be eligibility questions or other things that are needed. You want to go to the SBA contact. A lot of times we have something that might be needed to be signed by the franchisor, and we hand it to the borrower, and the borrower hands it to someone else, and they hand it up to the franchisor. This is the contact that we've gotten directly from leadership at the brand for those issues. So you save a lot of time, you'll save a lot of effort just going right to the SBA contact. Franchise financing is our underwriting and performance contact. This is the contact that's made available for any performance or underwriting questions that we have throughout the course of the deal. Now, we're going to talk about how we underwrite performance with fund scores, but not every brand puts full transparency, puts the full see-through in their financials in those public disclosures. So anytime we have a question about brand performance, if we have lack of disclosure, missing information, maybe we have a startup with borrower projecting 2 years worth of numbers, and we want to see if those are in line with what we would expect to see from another franchisee. Maybe that's not in the disclosure. Anything like that, we want to reach out to the franchise financing contact. And that's a really great resource for any credit folks on the call that might need to talk to the brand. So make sure to do that. And then franchise sales is for our biz dev folks. And I know there are a couple of those hidden on the call here. That is a contact that has been provided for folks that want to talk about direct lending relationships with franchise brands. And that is a lot of what we do to help our subscribing banks as well, is to sort of say, hey, we get deal flow from our branch network and the business that we do generally. We get deals from our referral sources, but we're paying a fee for that. Wouldn't it be great if we could establish direct relationships with the brand and get deal flow directly from them? And that's a lot of, again, what we do with lenders is help open up that third avenue of deal flow. And you can do a lot just by reaching out to the franchise sales contact. So I want to make that point on the call. There's a lot of important information just in the contact section. But when we go over to the underwriting tab, you see the ability to download the franchise disclosure document. And right here in other documents, we see that eligibility certification. So if you come down here for a brand and you see nothing there, or even if you see a 2023 now, we're a little bit farther in 2024. So we would expect a lot of brands to have their 2024 FDD out. This brand doesn't. This brand does a later issuance of their FDD. So they're not quite yet on the 2024. But if there is no document, or if there is a 2023 or older, that's when you want to reach out to us. There's an email address here, franchiseregistry@FRANdata.com. You'll get my email a little bit later in the call. Any of us that get these requests, they're going to be funneled to a specific point. We will respond to you within 24 hours, and then we'll go out after the franchisor. We'll reach out to the executives. We'll let them know there's a deal in process. We'll explain the eligibility certification. And so just clicking on that document, you're going to get that here. And then you can see what an executed certification looks like. Again, this was done in late 2023 for their 2023 FDD. Same form in the document, you can see it's filled out by Sport Clips. And at the bottom of this, we have a signed document by Franklin Bird, who's the CFO. So that's what you should expect to see when you actually get on franchise registry. But again, if you see an older one or you see one that's missing, just reach out to us and we can go out to the franchisor and get that information filled in. Okay, I got a couple things in Q&A. I'm going to take a click. Okay, first question is, how often does FRANdata review franchise agreements for the same brand? We do not review the franchise agreements for eligibility. Typically, it is on an annual basis. We do our fund reports and scores on a yearly basis unless there is new information that's updated from the brand. So the FTC has a rule, Federal Trade Commission franchise rule, says that if you are actively selling new units to prospective franchisees, you got to file that FDD at least once a year. So that's when we get those financials. Now, if the brand does an amended FDD, then they'll issue that amendment. We'll receive that document. And if there are any new financials or anything, we may issue an update to the fund report. But typically that happens on a 1-year basis. And a question then as well about the fund report and the score. What is the range of the score? We're going to get into some more detail about that, but it's a great question in the beginning. The fund score is very much like a FICO score for a franchise brand. The maximum score that a brand can get is 950 points. And most of our subscribing banks are looking at a top tier franchise at about a 700 or 750 or better. That doesn't mean a lot to you guys right now. It's going to mean a little bit more when we go and look at the fund reports and scores. But right about a 700 or better. Now, maybe 600 or better if we're in footprint, if we like the borrower, things of that nature. Banks typically don't use the fund score as the end all be all, but as a part of a package that we evaluate to say, do we want to do this deal or not, based on the strength of our borrower and the strength of the brand. But good question on fund scores, and we'll get into that in more detail here in a bit. Okay. Wanted to update on franchise lending market and what we're seeing. We do this in every presentation. Some of the stuff is similar. We continue to hear this, but there have been some changes and things that we got from the conferences and the lenders that have been participating. We talked about this last time, that unit profitability is being challenged in 2024, even in brands that are highly successful. So brands that have a high fund score, that have that 700 or better score, there are a lot of brands that bottom line profitability is still being challenged and eroding away, even in our stronger brands. The fund report that we're going to look at today is the 2024 fund report for Chicken Salad Chick. And folks that have been following these sessions, we know that, I sort of threw out that example that unit profitability is being challenged, and even Chicken Salad Chick, which is a really strong brand, had seen profitability declining, and we were waiting to see what we saw in 2024. Well, good news from them, their unit profitability actually ticked up a little bit. So they're doing a little bit better than the rest of the group. But why is this happening? It's the triple threat, the knock-on effects of inflation, labor, and interest rates all kind of coming together, right? Inflation is making the cost of these franchise units go up in terms of materials and cost of everything from windows to concrete. So building the units has gone up. Staffing the units has been more difficult and has gone up in cost. And then the cost of the money in the project overall has gone up with interest rates rising. So all of these three things together have conspired to really, whittle away profitability and really change which deals will cash flow. Maybe that did cash flow in 21 and 22 don't cash flow as well. Same looking deal in the same brand doesn't cash flow today like it did previously. And that was another one of the tidbits that we got from our panel, was that, we're not, the Carolyn from First Bank of Lake was sort of saying, we're not seeing a ton of defaults yet, but we're seeing folks that are, raising a hand and saying, I need help. They're getting extensions, they're looking for, different terms, different ways to help. So they're starting to see some of that in the portfolio. Not wholesale defaults yet, but folks that are sort of raising their hand and saying the water level is rising a little bit too fast. On the franchise door side, we're seeing a lot of new franchise brands that are open to new lending partners that are exploring the universe of banks that are out there. And some of those are emerging brands, and we're going to talk about what emerging brands mean, but really those are the smaller franchisors, that franchisors have less than 50 units out there in the world. A lot of those folks that are looking for new partners are emerging, but some really are the experienced, mature brands that have a ton of market presence and have been there for a while. And some of them are brands that are sort of shifting their franchisee base. Even think about like a Chicken Salad Chick, which we're going to look at later. I think they're at about 180 or so units right now, and had some slower incremental growth, but as a brand puts on units through single unit owners and maybe 2-unit operators, there's an inflection point there where they start to move into, okay, now we're looking for larger multi-unit folks to come in from other brands, to come in and buy up maybe underperforming units, or maybe single unit owners that want to sell. So you see a lot of consolidation and M&A activity that happens. So we're seeing that, and that means that there are mature brands out there that are looking for new partners as well. So there's a lot of opportunity, and even still in the small deals, I hammer this on every webinar until we see a difference, but it really continues to be out there. Small deals and small project sizes remain underserved in the economy in general, but specifically in franchising. One of the cool things that we saw at America East, though, was that when they put the SBA numbers up, the small dollar loan program was up like 30% year over year in terms of a dollar amount, and I think close to that in number of loans. So we know it's a problem. SBA as a whole is addressing it. We're doing a good job, but still in the franchise space, there's a need there. And some of the breakout panelists also shared that the costs of running an SBA shop have increased dramatically over the last 12 to 18 months, and that has to do with the costs of hiring folks going up and poaching from other shops. But it was something that was on the mind of the panel, and I thought was interesting to share with you guys here. All right, this is a slide from last time as we go into the SOP, and I wanted to use this as a transition to wake us up to say, hey, wait a minute, if we have a franchise loan, it's not just an eligibility question, it's also a performance question. And we looked in the SOP, we did a search with ChatGPT last time, we looked to see, hey, do they ever mention prudent lending in the SBA SOP? Yeah, they do. They mention it in many places, but do they actually define what prudent lending standards are? And as we all know, they don't, right? They don't, there's not a clear-cut definition of prudent lending standards, but we sort of have language that says we should follow commercially reasonable and prudent practices consistent with those used in similarly sized non-guaranteed SBA commercial loans. And we all have issues and problems with that statement. But even though it doesn't talk specifically about prudent lending and what that is, the SOP does make some specific statements about what we should do and need to do if the loan involves a franchise. And they do this in two different loan programs. One is in the 7A portion of the SOP that speaks about loans greater than 500K. And this also applies to the cap lines in the international trade product. And there's a whole section of things we need to do in different cases in A, B, C, D, and you get all the way down to I, and it says discussion of other relevant information. For example, if the application involves a franchise, lenders must review any credit information provided, such as the number of failed franchisees and cash flow projections provided by the franchisor, not the borrower, but the brand. And that's where we get into the franchise disclosure document, the disclosures from the brand, and our fund report that actually analyzes and evaluates brand performance. That's required for any loan that's 500K or above. So at the very least, and we went over this in our breakout session, we need to have at least a rubric or a checklist that says, here are our points that we're looking at from the franchisor, and whether that comes from the brand or the disclosure or whatever, at a bare minimum, we have to have a checklist of things we need to look through. But banks obviously go as far as to subscribe to our fund reports because that provides them a much more comprehensive look at performance and saves them the time of going in there and having to do that. So it's an important point. Same thing is present for a CDC credit memorandum. They put a little bit more of a finer point on it when they talk about independent studies or reports. They say, hey, reports prepared independently of the business may be beneficial for you as a lender to mitigate any credit weaknesses that might be found. And they went right out and said, hey, an example of these reports may include franchise assessment reports, right? So they're aware that this is an issue, that lenders need to do this, but we're not quite convinced that every bank out there has a policy or even understands that this is a requirement with respect to franchise lending, that we have to evaluate the performance of the franchisor along with the performance of the borrower we're lending to these brands. I've got a question here. I've got two. Okay, question is, what protections to the lenders does the franchisor certification provide if the SBA still requires lenders to review the franchise agreement? Well, the requirement is that lenders need to secure and have looked at eligibility. This is a document that has the franchisor certifying that they do not offend any of the 26 or 27 elements that are in that eligibility certification. If the franchisor is not willing to sign, or if your institution isn't comfortable with using the certification, then in that case, we would recommend that you would go to an outside attorney to do that review on a one-off basis. Or again, if you have someone internally to handle that you feel comfortable with, then you would go that path. None of the three are a perfect solution, but you just have to sort of pick based upon what your institution needs and what the requirements are for you guys internally. Second question, a lot of franchisors don't want to provide projections. Any suggestions for dealing with that? Well, that's really what we deal with kind of day in and day out with FRANdata. Some brands don't want to provide projections. Someone's coming over here. I've been told I have 3 questions in chat. We're going to get to that. Okay, so they want to provide projections. We work with franchisors to tell them why they should provide projections. We have mechanisms for them to do that in the report. We call it bank credit report, which is essentially franchisor discloses their financials to us. We provide them to lenders under a non-disclosure agreement, and it doesn't get out into the public space. So the biggest sort of hang up for franchisors about why they don't put this stuff out there, they don't put the projections in the FDD, is because that's a public document and they don't want it out there for whatever reason. They may think the numbers are too low, they may think they're too high, they may not be collecting them in any kind of real organized way. But a lot of times they're able to disclose this stuff one-on-one to you. And that's why we emphasize relationship building with these brands. And that's something that we help folks do. But at the end of the day, if they're not going to give them directly to you and they're not going to disclose them, then that to me is a red flag. When I started at FRANdata, the percentage of brands that disclosed unit economic financials and at franchisor level P&Ls was at, I think, about 45 or 50%. Today, it's at about 75 to 80%. So it's much more the standard to have information than not. And if you have a brand that's really digging in their heels and doesn't want to provide the information, then it might be a brand that you just need to pass on and move on. Okay. Will there be a copy of the slides provided? Absolutely, we will. There's some questions about fund reports here that I want to either save for later or answer offline. One is, has the SBA reviewed the fund report and blessed it? SBA report doesn't bless much these days. But I know that they are aware that we're doing fund reports and they know that a lot of banks rely on them. Tough to get a blessing out of them. How long does it take to obtain an SBA eligibility certification? Usually about a week or so turnaround. It depends on how much explaining we need to do and how much their legal team needs to review. It might be a week or two. So just get in front of that as soon as you can in the process. And we'll try to meet those timelines. But right now it's about 2 weeks or so. And the final question is around, do I have recommendations on how the fund report for a brand should be used in the credit memo? And yes, it should be used in the credit memo. And we can talk about how you structure your credit memo and what things are important. And maybe we can uncover some things that you didn't think were important, but maybe are, and how that fits with the fund report. And should it be a supplement to your credit memo or should it replace it entirely? And that's all stuff that we can have an offline conversation. Those questions are a fabulous transition, though, into how we at FRANdata help lenders evaluate franchise performance and meet those SBA requirements. We're going to go through a couple of things. First, we're going to now completely define emerging versus mature brand. We've touched on that a little bit, but I'm going to just give you some numbers and guardrails and how we talk about that. Then I want to go in and we're going to look at that fund report for Chicken Salad Chick 2024. And with that, I'll go through, if not all the categories, most of the categories in the fund report, so you can see where they're coming from and where that score we talked about is built on. And then we're going to look at some more detail on emerging brands. Folks that have been on my webinars before have seen some similar slides on emerging brands, but it remains really important to understand who they are, where they're coming from, and what their general mindset is and how to evaluate them. Because if we're putting a flag out that we're doing franchise loans, we're going to see some emerging brands along with the mature folks. Now, we define emerging brands as, and I think I might have mentioned this before, but any brand that has listed 50 franchise units in the United States and less than 5 years in franchising. When we say in franchising, we mean 5 years worth of franchise disclosure documents that are published and available, right? So we said before, FTC franchise rule says if we're selling new units, we got to have an FDD on a yearly basis. So if we have 5 years worth of FDDs, we're good to go. We've been franchising for 5 years and 50 franchise units in the United States. That is the threshold by which we will do a fund report. We will only do a fund report, which is the scored report you're going to look at on a mature brand. We do a report on an emerging brand called a pre-fund report that looks at a lot of the same categories and a lot of the same things, but we do not score the brand because we need to see sufficient seasoning in those units before we evaluate them across a standard metric. The easiest way to think about this is, and we'll look at this when we look at historical unit success, but if I open some units of a new brand in year one, by year two, am I expecting those to be closed? No, we're not going to know how the units in year one and year two actually did really until year 4 and year 5. And that's what the slides at the end of the presentation are going to sort of tease out for you. But again, it's about the seasoning in the units and making sure that we have a real picture of their performance before we start to slot them in with the fund score against the other brands in the universe. We touched on this. Mature brands generally have more historical performance data available. So there's more information out there for us to evaluate them, but they're more likely to have established relationships. Not all of them. And as we said before, a lot of them are exploring new partners, but they're more likely to have relationships. Emerging brands are the ones that are going to be in your face. They have much less performance data available, but they're often looking for lenders to and partners that are going to drive growth and have very high outsized expectations about where that unit growth is going to come from and the speed at which they're going to ramp up. And that, again, is in some of the slides we're going to look at a little bit later. Further to the question from the gentleman before, I wanted to sort of get our feet wet on the score and what it means before we go actually into the report and get a sense of, well, where is this activity happening? Is it just in a specific sector or industry, or is it across, all brands in franchising? As we mentioned before, 700 or 750 or better are typically what we would consider a high performing brand. And when we look at the concentration of top fund scores by sector and industry, we find that there is a distribution of top performing brands across all different sectors and industries in what we call the franchise economy, right? I've got other slides that I didn't put in this presentation that sort of look at the franchise universe today and dispel this notion that franchising is all about food, right? We think about franchising, we think about large national food brands, but those other slides show that franchising today is actually 60% non-food. And this is further to that point. We look at, the industries that have these top performing brands. They're in all types of industries, child-related, beauty-related, sports and recreation, before we even get to the food concepts. There's a lot of opportunity in all different aspects of franchising, despite what you might think franchising is really about. Now, as promised, we're going to go over and take a look at the fund report for Chicken Salad Chicken. So as I said before, fund report is an independent analysis of franchise brand performance. It's made with the publicly available information. And there are 12 different categories in this report that add up to that top score potential of 950. I think the highest score we have is a 910 or 920. And a handful of those folks are in the early childhood education space. So your Goddard School, your Primrose, Kiddie Academy, those folks. So 950 points, 12 categories. And we look at both unit level performance and system level performance. So what's happening with the units of Chicken Salad Chicken on the ground versus the system level, Simply Southern Restaurant Group. That's the group that's selling the units and collecting the royalties. And we look at both quantitative and qualitative measures. So a quantitative measure would be the first category, which we're going to pop back to, which is historical unit success. Qualitative measure would be something like management experience and stability, or franchisor-franchisee relationship, which looks at any bankruptcies and litigations that might be present within the brand. As I said, first category of the report is historical unit success. This is one of our quantitative categories. And this is really important because this really drills into how are the units performing on the ground today. And a lot of folks may be using, other information. You might be using SBA loan loss information. Coleman Report does a fantastic report on SBA data. But this is important because we're looking at an 8-year picture of performance, an 8-year window of unit performance. And we're looking at all the unit activity in the system, not just ones that got SBA loans. This looks at, did the brand get an SBA loan? Was it self-finance? Was it conventional? Whatever it was. So it's all the unit activity in the system. And we're doing two things in this category. First, we're taking an 8-year inter-year look back, which I'm going to break down for you in a sec. So for the past 8 years, how did we do for each individual year? And then we're compounding that success rate over time, over the 8 years. And that is the number that is being benchmarked against peers and what determines the historical unit success rate score at the top. So with a 93.8 compounded success rate, they've got a 130 out of 150. And that puts them in the top quintile of compounded success rates. We only give points for brands that fall in the top or the upper middle quintile. We do not assign point values below 80% compounded success rate. Diving into the annual unit success, or say, how do we do each of these? That's where we look at the franchise disclosure documents. Now, I'm going to give you an example here using the 2024 FDD. And what we do is we look at the item 20. Now, the item 20 is the unit information for this brand. And typically, the current disclosure document is going to give you the past 3 years worth of performance. right? So in this year, it's 2024 FDD, we get 21, 22, and 23. And you can see we've gone back to 2016. So this represents several years worth of disclosures to be able to get this performance. Now, what do we key in on here? When you go into an item 20 at the beginning, it's giving you this sort of global table of what we did with franchise outlets and company-owned outlets. What we want to pay attention to is this detail. As we roll down from that top, you can see they break down the states where every unit is in each state. And what I'm focusing in here on now is the total of all states. And this gives us the statuses by which a unit entered and exited this franchise system. So it tells us the units at the beginning of the year, how many units we had at the end of the year. We look at how many units we opened during, but then we want to key on, and this is what we look at in the HSR, how many units did we lose during the period, and what were the statuses by which we lost those units? There are 4 ways by which a franchise unit can quit a system. We have termination, non-renewal, reacquired, and ceased operations other. 2 of those are typically a negative outcome for a bank. So when we report in the fund report, you see here in 2017, they didn't get 100% annual unit success. What does that mean? It means in that year, they had either a termination or a ceased operation. Termination means the franchisor terminates the franchisee for some breach of the franchise agreement. Typically, in that case, the loan is not repaid. And ceased operations other is where the franchisee quits the business, basically throws the keys to the landlord, walks away, and says, we're done. And again, in that situation, typically the loan is not repaid. Now, non-renewal and reacquired are a lot different. Non-renewal just means that the term of our franchise agreement went to full expiration and both parties went their separate way. Most franchise agreements are a 10-year term with a 10-year renewal. So if we're terming our 7A loan to that term of the franchise agreement, that agreement has expired, our loan term has gone to expiration, everyone's paid off, everybody's happy. Reacquired, on the other hand, is when the franchisor repurchases the underperforming unit from the franchisee and turns it back into a company owner. And typically in those cases, they're going to repay the note, or they're going to continue to pay the loan. And so those to us are not a negative outcome for a bank, and thus in the fund report, we do not count that against the brand and the annual unit success. So we're looking for negative outcomes, closures that likely resulted in a loss of credit. And those will happen in a termination and the ceased operations of it. So that's how the public information plays into our analysis of the historical unit success. And hopefully, if you're not using our fund reports, there are some thumbnails and tips there that can start to get you on the path of understanding, all right, how would I look at historical unit success when I'm looking at a particular franchise deal? From there, the next 3 categories are about unit level performance. So we looked at open closed units and failures. Now we're looking at resale activity, top line revenue, and bottom line profitability, such as it is reported by the brand. Resale activity level is transfer activity. That means units that are being sold from one franchisee to another. And we look for a favorable band of activity based on the maturity of the system. We don't want to see resale rates generally going too high. In our past research, that can be an indicator that there are issues in the brand and folks are leaving. And again, it's a function of their maturity level, because we wouldn't expect a young emerging brand that's been around for 5 years to have a ton of resale activity. Where a legacy system that's been around 20 or 30 years, you would expect a little bit more activity and some more turnover. So that's how that plays in. Transfer category, that's in the FDD as well. You want to pay attention to that. And then with same store sales and unit economics, pretty straightforward in terms of what we're reporting on, right? It's the top line revenue and the bottom line profitability of the units on the ground. But this is where that transparency question came in from the audience before. Right? What if they don't disclose information? Well, transparency is very, very important to us. So first we look to see, do they disclose anything in the FDD? As I said before, it's about 75% transparency today in terms of franchise brands that are doing this. So do they have any information at all? If they give us nothing in the FDD, they get a 0 in the fund report. They get a 0 out of 70 here, and they get a 0 out of 100 in unit economics for not disclosing any information. That's going to take a fund score down quite a bit. And that can also be some of the impetus for a franchisor to go through that disclosure process with a bank credit report. Nobody likes a low score, especially when it's their brand. But again, there might be reasons why they don't put that in the public documents. So when we have fund reports with low scores or lack of information, we're reaching out to the franchisor to see if they're willing to disclose it to us. That's an important part of this. So anytime you pull a fund report where there's a 0 for lack of transparency, know that we can reach out to the franchisor to try to get more information from them. Once there is information there, then we're looking at, okay, what percentage of the system are they giving us? And does that constitute significant transparency? If they have 200 units, they only give us 20 unit reporting, we're not confident in that number. In this case, Chicken Salad Chick reported on 88% of the franchise system units, which is fantastic. And then now we're looking at the last 4 years of performance. We're giving you a 3-year growth rate, and we are benchmarking that against a peer set that we pick for this report. So typically 4 to 6 brands. Whereas in historical unit success, we're looking at benchmarks against the entire franchise universe. So this is a really important category. Obviously, it's driven first by transparency and then by the information and the data that's being shown. Biggest thing to remember with this and anything else that you're seeing is when you have transparency issues and lack of information, that's a trigger point to reach out to us, and we can get out to the franchisor and potentially help them. The final categories in the report then now focus on the franchisor level, the brand level, right? So we looked at the unit performance, we looked at the unit financial numbers. Now we're going up to the brand level. We talked about one of those qualitative measures, franchisor-franchisee relationship. Is the brand suing its franchisees, or are the franchisees suing the franchisor? Important to pay attention to. We look at lawsuits, bankruptcies, and satisfaction surveys that might be present. And we're also searching on different websites and social media. Of late, we've expanded to looking at Instagram and Twitter and TikTok and these things because, typically the franchise or unhappy franchisees were funneled into these few websites where they would gather and complain. One of them was actually called Unhappy Franchisee. But now it's getting more in the mainstream. So we look at that as well. And think of that category as sort of reputational risk. Anything that we're going to be seeing in the universe that might affect them, we'll bring that down there. Recurring revenue self-sufficiency is an important metric on the franchisor level. It's just asking, do we take in enough money from our recurring revenue streams and our royalty streams to pay our ongoing expenses? Or do we need to open up some more units and collect some more royalties before we're there? Chicken Salad Chick has been hovering right around this. I think last year they got the 50 points for this. This year they were not recurring revenue self-sufficient. They're a system that's in transition from emerging to mature. We would expect them to maintain that 50 points there in the future. So this is a brand, even with a 720 fund score, has got some room for improvement here. Financial statement strength looks at that franchisor entity, Simply Southern Restaurant Group, and looks at the same things that we looked at in top line revenue and bottom line profitability for the units. How much money are we taking in? What's our cash flow position? What's our long-term and short-term debt position? And do we feel like we have enough cash flow to cover those positions, or is this a brand that may be in danger of declaring bankruptcy on the franchisor level? It's important to pay attention to that. System support and expense commitment looks at the franchise agreement itself and looks at what are the support services that the franchisor says they're providing. Are those standard services that we would expect to see? And then how much of their expense commitment are they actually putting towards those efforts? So in this case, we were able to identify what the support services were. But because of a lack of breakdown in their franchisor level financials, we don't know how much money they're putting into those efforts. When you get in their FDD and you look and you see in the franchisor level, they're giving you, the total operating expenses, sort of general administrative expenses. It's all lumped together. If we have a breakdown there of, hey, what do we spend on advertising? What do we spend on training? What do we do that? We can understand better about what they're doing to support their folks, and they're going to get more points there. Management experience and stability looks at the executive team and just asks, how long have they been with this brand? How long have they been in a similar sector and industry in franchising? How long have they been in franchising as a whole? If a brand loses points in this category, for anything other than that, they're typically going to lose it for what we call a split focus, meaning the brand is owned by a large organization that may own multiple brands, and we have folks that have the same role across multiple concepts. So I'm the chief marketing officer of 3 different brands. We're going to dock you some points for a split focus that we see there. Prospect screening is really important. That looks at the minimum net worth and liquidity requirements that the franchisor sets out for its prospective franchisees. This is typically not in the FDD. This is on their website or some other place that they put in the public view. But this is important for a couple of reasons. One, in this category, we evaluate the minimum net worth and liquidity as a function of the initial investment size of the brand to ask, is this a low barrier to entry, a medium barrier to entry, high barrier to entry? How selective are we being with the franchisees that go into the system? And then for the lenders on the call that are doing deals to these brands, are the borrowers that are coming through the door meeting those standards that the franchisor said they were going to have? Or is there some kind of slippage there between what's happening on the ground and what the brand says they're going to do? And that can happen for a lot of reasons. They may be using franchisee recruitment services or broker referrals. Sometimes they'll pay the broker a percentage of the initial franchise fee. And so they can get a little bit aggressive on recruiting. Pay attention to that. Know what the minimum net worth requirements are. Make sure you're comfortable with it first. And then are our borrowers meeting those standards? Then if not, why not? Two more categories in the report. And the next one is called franchise agreement assessment. And this is not an eligibility concern. This is us reviewing and looking at the franchise agreement for any clauses that are going to affect your package from a credit perspective. That could be excessive transfer fees. That could be sole sourcing requirements, right? My borrower has to purchase all the equipment from a designated supplier, and oftentimes the franchisor has a financial interest in that supplier. Does my borrower get a protected territory? And liquidated damages is one as well that has really come up lately with franchise brands. If my borrower's location closes, they may owe 36 months or 48 months worth of uncollected royalties to that franchisor, and that may affect your credit position. So franchise agreement assessment, anything in the agreement that's going to affect you from a credit package. Typically brands have something in this that dings them, but it's important to pay attention to that and make sure there's nothing there that is going to affect you guys. And the final category in the report is projected unit success. That is where we're taking everything we've learned so far. So we're baking in historical unit success, their financials. Are they transparent? Are they not? And we're looking to see what we think the next unit in this brand is going to do and the franchise system as a whole is going to do into the future. And this is where we look at any sector and industry headwinds and tailwinds, but what's happening in the restaurant space and the food space. When we had the challenges with COVID, we would have COVID effects here. So anything that's going to affect the sector that the brand is in is also going to be baked in with the projected unit success. That is a mouthful to go over in one shot, but it's really, really dense. There's a lot of information packed into that, again, on both the brand level and the franchisor level. And these are the kind of things that lenders need to pay attention to when we're looking at franchisor performance. This is the comprehensive look. This is looking at everything that is going to affect brand performance. Whether or not you do a high volume of franchise loans is going to determine, hey, do we go with a smaller sort of rubric or checklist, or do we go all the way up to fund reports to support the franchise lending efforts? Got a couple of bubbles in chat. I just want to check this because there were some questions in here before. Don't think so. Okay, great. Fabulous. So that's fund reports in a nutshell. And I want to wrap up by a couple of slides that I promised you guys on emerging brands and just sort of tie us all off and head on home. So emerging brands in more detail. Why do we treat them differently? Why are they special? What should we look out for? And are there any exceptions to those rules? So on the slide here is an answer to that final question. About 86% of the emerging brands that we look at today are what we would call sort of true startups, right? Where they are a company or business that was founded maybe with a business partner or a spouse. It's a 2-person or a 3-person team. And they've opened a unit or 2 or 3 and business is going great. But we're looking over the horizon and we're thinking, hey, there's no way we can open 10, we can open 15. What about franchising? Maybe we can do this. So that is much more the picture of an emerging brand, of a business that starts as a true small business and then moves into franchising, rather than an experienced franchise company that's creating a new brand. And that would be the exception to that, right? So about 14% are brands that are already existing that are creating new concepts. And the example I've been giving for this one of late is a concept called BWW Go, Buffalo Wild Wings Go. It's a separate FED, it's a separate franchise agreement, it's a different thing, but it's run by Buffalo Wild Wings. In fact, some of the main Buffalo Wild Wings franchisees are a little bit upset that they have come out with this low footprint, quick and easy, all to go model that some think are cannibalizing from the existing Buffalo Wild Wings locations. That's a different deal. Why are we worried about a true startup in the emerging brand world? Is because on the right, it takes a lot of different professional experience skill sets to really run a franchise brand all the way around. And the founding group may well have management, sales, operations, or a mix of those, but it's very rare that they have everything down this sort of long tail of experience that's needed in finance and marketing, HR, IT, legal. So this is why we're very sort of taking a longer run approach when it comes to emerging brands, because we know it takes time to put all of these aspects in place. But it doesn't take away from their ambitions at all. And I hinted at this in the beginning. One of the slides that I didn't show in this presentation was, where are brands today? What percentage of brands today actually are national or multinational brands? And that answer is about 17%. But when we survey emerging brand franchisors and owners, 72% of them plan to grow their brand into a national or international presence within the next 5 years. Right. So our takeaway there is that the early stage franchisors often have ambitions that are unrealistic. That when we see real growth in emerging brands, what we see across most brands are slow incremental growth, right? The race to success is not how many units we can open in a year. I know that that's what we want to celebrate in Entrepreneur, top 100 and fastest growing brands, but fast growing brands are the exception rather than the norm. They often have what we call digestion issues down the line. They didn't pick the right location, they didn't pick the right franchisee. There's a lot that can happen. What we see typically is slow incremental growth, right? 2 to 3 units in the first year, 4 to 5 in year 2 and year 3, up to 8, 10 in year 4 and year 5, getting to around to that 5 years, 50 units. That's what we typically see. The fast growers are the exception. They typically have problems down the line. And the final slide here is why we wait. And I hinted at this before. Why do we wait that 5 years to do the fund report? Is that when we look at emerging brands in general, the continuity rate will start to level off in year 4 and year 5, meaning that we're not going to see units fail until that 3rd or 4th or 5th year. So it doesn't make any sense for us to come out and tell you that this brand's been around for 2 years, has a 100% success rate. We don't have that much confidence in that yet. We need to see the seasoning and to see that 5th year happen. And that's what we see across all emerging brands, is their true performance starts to show around year 4 and year 5 of an emerging brand. All right. We've got a couple minutes left. We are going to pop a survey here. Melinda is in charge, as always. It's going to show a survey at the end of the webinar. So we would love it if you leave some feedback, let us know how we did, how we can help you. Folks that had questions about how this might fit into their credit box or anything like that, please email us. We could talk to you about that. I have one more bubble in chat. That's just Melinda saying, please submit any final questions. And I don't have any yet in the Q&A. So while we're waiting, I'll leave my email address up there. So you might have gotten franchise registry at FRANdata.com as an email through this. My email is available. There's some other lender support folks like Tony CP who might be in the call somewhere, who I'm sure you folks know. But please reach out to us with anything franchise related. If it's an eligibility question, if it's a performance question, how we should be looking at brands, really anything. I'm happy to help you guys and your institution. So thank you again for joining us today. We'll have a recording that'll go out, and I don't see any questions popping up. So you guys have a wonderful day, and we'll see you again soon. Thank you.